Standard deviations. I think that's what we're gonna do, and that's what I promised. Mind you, I'm building a model for you. Yesterday it was a new week opening gap. Today it's more of a standard deviations, and then we will see how we use these in order to capture those trades. By the way, if you look at my our market outlook, you will find that most targets are hit. So just a side note for you, I know it's not trading advice, um, but the opinion we had for the market, it was wonderful. Now let me not keep you and do for you a standard deviation. How do we do standard deviation? Now, generally on standard deviations, you want the time of um, of 4 o'clock. You want 4 o'clock. This is all New York time. All New York time. You want 4 o'clock. You want 4 o'clock. Roughly 8 o'clock. Now in these two price points here, what you want, you want you want the highest point and the lowest point. Now you only want it for 15 pips. You only want it for 15 pips. Now if you look at it from this one up until this one, you just take your horizontal level. This one is already drawn it, but it's the new week opening. So I'll use this one so that you see, but I'll just change the color and make it red. Yeah, and then there's another horizontal line here, and then yeah, so the highest and the lowest point. Yeah, and then you look for 15 pips. If you can't get 15 pips, then you don't use that standard deviation. So what you do, you just put this here, put it right at that line, and then boom, you've got 25 pips. You've got 25.9 pips. Now how you do it, you no longer use the second one. What you do, you just take this same cursor here, and then you just times it 3 times. 25.9 times 3. That that's roughly 75 pips of your stop loss. Meaning today you don't buy after 75 pips. It's just simple as that. You don't buy after 75 pips or 76 pips plus if you wanna really turn on the screws about being correct or not being correct. 76, if you wanna use round it off, maybe 26 pips, 26 pips, 26 pips down. You don't wanna do it. You see, that's how you do standard deviations. Now this is how you do them on currencies, but let me add something here for the NAS and other markets. Now this method, we use it for gold and other market classes. Now what you want to do with this one is quite different, very very different, um, but still the method is still the same. Take a vertical line. I don't know what's the problem with my connection. Take a vertical line and you place it at 1:30, straight at 1:30, up until 4 o'clock. Yeah, place it right here. Place it right here. Then the only thing you need is the highs and the lows. Only thing you need is the highs and the lows. So you come back to this horizontal line here. This is the highest high, and the NAS, make it red. And then this is the lowest low. So in both these highs there are two liquidity grabs here, this one and this one. If you want to go bullish today, you can just wait up until it takes these two guys out and then go bullish. If you wanna go bearish, you can wait for it to take these two guys out and then you can go bearish. That's how you do standard deviations. This one is much more better than because we use it for gold, we use it for indices, but the first ones we use it for the markets, in the currency space. Now what I wanted to show you here, this video better not be more than 10 minutes. What I wanted to show you here, if we didn't find the 25 pips on the euro, we would have used what we call the central bankers dealers range. The central bankers dealers range starts at 4 up until 4 p.m. New York time, up until 12 midnight New York time. It starts at 8. Sorry, it doesn't start at 4. What starts at 4, it's the central dealers range. But Asian session starts at 8 up until midnight New York time. Yeah, that's how it goes. And then if we didn't find the 15 pips plus today, then we would have used the Asian session. Now on Asian session we want 20 pips plus, but I'm not gonna show you because I've already shown you how we do it on the first one. Now what you want to do on the Asian, maybe to lower risk, because everybody is gonna say to me, I'm not gonna have a 75 pip stop loss, you see. And another person might say, I can have a 60 pip stop loss depending on the risk that you have, or the risk appetite that you have. But yeah, that's all good. It's all good. It's all good. It's all good. It's all good. And then and then I wanna go in on if you don't find, also if you don't find the 15 pips or the 20 pips in both these time frames, in these time sessions of 4 o'clock to midnight. If you don't find both of them, then you use the flout, meaning the range between 4 o'clock and midnight New York, and then you create a standard deviation. But all that will be shown and be taught. I just don't want to teach things that are not there, but I want to teach things which are there. So today, please just be content with the Nasdaq one of doing standard deviations and how you trade these days, and then obviously, thanks for the euro. And hopefully, if you find this insightful, please like and subscribe on the channel. Yeah, and I'll give you such content for free every time and every day. Thank you. And today, don't forget, at around about 5 o'clock New York time, we have news, CPI news on the euro. So you might want to look for a trade over them, or maybe do something. Yeah, show me your analysis, and I'll show you mine. I think I'll show you mine if there's a trade to take. Yeah, that's it. Thank you. Don't forget to like and subscribe, or even share the channel. It will really help me. Thank you. Bye.